Thank you, Mr. Chairman, and thank you to the chairman for coming to testify before us. I appreciate the job you do, and you have a hard job. I want to ask you about one big picture question and then talk about some things that are important in my district. The big picture question is, I've been here 13 months, and I've pretty quickly realized that the only things that happen in this town are the things that have to happen. And you've heard some really robust debate in this committee about how we might solve our fiscal crisis. You've admitted that it is the thing we should stay focused on, and I believe the best way to fix it is to require it to happen through a balanced budget amendment. That doesn't say that how we will balance the budget, but it just requires it to happen, and I do believe we can do that in a thoughtful way with some relief valves for natural disaster, time of war, for only that spending related to those activities. And usually you punt these questions, but I'm going to ask you anyway. What do you think about a balanced budget amendment as a technique for solving our fiscal crisis long term and forcing it to become one of the things that has to happen in this town?
Well, in general, I think there's some evidence that rules or structures are helpful in getting better fiscal outcomes. You know, for example, offsets and things of that sort. I think 1 year might be too short a time, you know, to demand balance, but over a longer period of time with appropriate provisions, some kind of rule, I don't know whether you want to go to the amendment route or not, but I think some kind of rule for the Congress to provide a guidepost both to its own deliberations and for the public's awareness, you know, could be a helpful structure to make things happen.
Thanks for that thoughtful answer. I do want to follow up on a question Mr. Clay just asked. You know, and I asked you this last year, but and I know that the Bureau of Labor Statistics does both of your measures that you measure yourself against, unemployment and inflation. And I just want to ask you to continue to pay attention to the way they measure things, because the unemployment number does not count the people who have dropped out and are no longer looking for work. It also does not account for underemployed folks. And as we go through structural changes in our economy, I'm not asking you to comment because I know you don't do these, but I am worried about the way that they count. I'm also worried about the way they count inflation, because when they put together the consumer basket for inflation, the reduction in the prices of housing is masking the massive increases in commodity prices, including oil and gas, including foodstuffs that people buy at the grocery store. And if you think about the way that people in my district and the rest of this country manage their finances, they lock in long-term rates on their housing through a mortgage or a long-term lease, and they have a known amount that they're going to pay, which changes only a minor amount. The thing that changes their real inflation they see is commodity prices, price of gas at the pump, the price of foodstuffs at the grocery store. So I know that the Bureau of Labor Statistics does that work for you, but I learned a long time ago in the military, you know, what you measure is what counts, and how you measure it counts. So I would remind you again to always review the way those things are measured. And I'm not asking you to comment because I know it's not yours, but well, I would like you to pay attention.
I would comment that the BLS does provide alternative unemployment measures, U5 and U6, which do take into account discouraged workers and so on.
And so I'd ask you to keep looking at those. The last thing I want to talk about is community banks. You mentioned it in your testimony when you talked about your work in the FSOC, and I think we all recognize that community banks weren't the interconnected cause of the crisis in 2008, and that they also bear a disparate impact of many of these regulations because of their size and the fact that they don't have big compliance departments. And you know, I'll tell you a story and then remind you to talk to your friends at the FDIC and the OCC, because I'll tell you, I've not heard a bad story about Fed regulators from community banks, but I've heard several horror stories about the FDIC, and I'll tell you a new one I've heard since the last time we talked. There's a community bank that recognized a borrower was in a deteriorating position. They asked him to put money in an account, signed an agreement with him, a forbearance agreement, but they got a year of principal and interest in a restricted account the consumer can't touch, so they know that loan is good for a year. And the FDIC came in and asked them to put all that money toward principal and write the loan down and violate their forbearance agreement with the customer, you know, and basically then downgrade the loan. Well, they know that loan's going to be good for a year, and the gentleman's financial condition may change in that year. They've taken responsible action, and the FDIC has forced them to do things that I think are irresponsible. My time's expired, but I would ask you to go back to the regulators at the FDIC and the OCC and ask them to please not encourage our community banks to do things that actually hurt borrowing and hurt our economy.
Thank you.
The gentleman from California.